You have probably seen the headline. It is everywhere on social media and in those flashy finance videos. It says the rich use debt to get richer. And if you are like most people, your first instinct is to think that this is some kind of secret cheat code. You picture the wealthy finding a way to spend money they do not actually have and somehow turning that into a fortune. Now, here is the thing. That headline is actually true. But it is only true for the people who understand the mechanics of how it works. For everyone else, trying to copy that headline without understanding the rules is one of the fastest ways to go broke. In fact, if you copy what most people think that headline means, debt will not make you rich. It will quietly keep you broke, charging you north of 20% a year while you think you are playing the game of the wealthy. Tonight, I want to show you the real line between debt that builds wealth and debt that eats it. And I am going to walk you through it as a story, one that might feel a little too familiar, because that is the best way to see where the traps are hidden. You will see that it is not the debt itself that is the problem, but where you point it. Welcome to Grow with Tony. I'm Tony, and today we're pulling apart one of the most misunderstood ideas in money, using debt as a tool, the honest version, with the parts the hype leaves out. Before we go any further, just a quick reminder that this video is for educational purposes only. It is not financial advice. Please do your own research and talk to a licensed professional before making any borrowing or investing decisions. So picture this. Let's say this is you. You are an ordinary person with a decent job and a few goals for your future. You are not reckless, but you are ambitious. You spend a lot of time scrolling through your phone, reading about wealth and success, and one afternoon, you see that headline. The rich use debt to get richer, and it clicks. You start thinking that the reason you are not getting ahead is because you have been too afraid of debt. You have been playing it too safe, trying to save every single penny while everyone else seems to be leveraging their way to the top. So you make a decision. You decide that if the wealthy use leverage to scale their success, then you should start using leverage too. Be honest. Can you already feel how reasonable that sounds? That is exactly why this trap catches so many people. Now, this is where things start to go wrong, and stay with me, because this is the exact mistake most people make. You do not stop to ask what kind of debt the rich are actually using. You just see the word debt and start applying it to your life. First, you decide you need to look the part. You figure that if you are going to be a person of wealth, you should drive a car that reflects that. So you finance a much nicer car than you can actually afford. The monthly payment is high, but you tell yourself it is an investment in your professional image. Then you start using your credit cards more freely. You tell yourself you are just managing your cash flow, letting a balance build up because you know you can pay it off eventually. You do not realize it yet, but you are stepping into a trap. But the real trouble starts when you decide to make your money work for you like the rich do. You have a bit of savings, maybe $10,000, and you learn about something called a margin account. Now, buying stocks on margin basically means you are borrowing money from your broker to buy more stock than you could afford with your own cash. Under the rules, specifically something called Regulation T, you find out you can borrow up to 50% of the purchase price. So with your $10,000, you use margin to buy $20,000 worth of stock. And at first, this feels like absolute magic. You have just discovered the power of leverage. Now, if you have never heard the term, leverage is just using borrowed money to control something bigger than your own cash allows. It is like a seesaw. It multiplies everything. Let me show you what that feels like with a bigger example. Imagine you control an asset worth $100,000, but only $20,000 of that is your own money. You borrowed the other $80,000. If that asset goes up by 10%, the total value becomes $110,000. That is a $10,000 gain. Now, $10,000 might not seem like a world-changing amount, but remember, you only put in $20,000 of your own money. A $10,000 gain on a $20,000 investment is a 50% return. You are thrilled. You feel like you have found a shortcut to wealth, seeing gains you could never reach just by saving your paycheck. Be honest. Does any of this sound familiar? That feeling that if you just find the right tool, the right leverage, you can leapfrog over years of slow saving. That is exactly where you are right now in our story. You are riding the upside of the seesaw, and you believe you have cracked the code. You think the debt is the engine driving your success. But here's the thing about leverage. It cuts both ways. The seesaw does not just multiply your gains. It multiplies your losses with the exact same intensity. And then the market does what it always does, eventually. It dips. It is not even a massive crash, just a standard market correction. But for you, this is where the dream turns into a nightmare. Because you are using margin, you are subject to strict rules. The broker requires you to keep a minimum amount of equity in your account, which is usually 25%. This is called the maintenance minimum. As the value of your stocks drops, your equity drops too. And suddenly, you get the email and the phone call that every margin trader fears. You have a margin call. A margin call is not a polite request. It is a demand. The broker tells you that you no longer have enough equity to cover the loan. You need to deposit more cash immediately, or they will take action. And you are panicked because you do not have any more cash. You spent your extra money on that nicer car, and your credit card balances have been growing. You cannot find the money in time. And here is the brutal part. When a margin call happens and you cannot meet it, the broker can force sell your investments. They do not have to ask for your permission. They do not have to wait for the market to recover. They sell your stocks at the bottom of the dip to protect their own loan. You watch in horror as your portfolio is liquidated at the worst possible moment. Because the leverage worked in reverse, a 10% drop in the market did not just mean a 10% loss for you. It meant a massive chunk of your own capital was wiped out. In some cases, if the drop is fast enough, you can actually end up owing the broker more money than you originally put in. So now you are at your lowest point. You have lost a huge portion of your savings. But the nightmare does not stop with the stocks. Because while you were chasing the magic of leverage, the other debts you ignored were quietly eating you alive. Your credit card balance has been growing, and the interest is compounding. If you check the most recent Federal Reserve data, the average interest rate on credit card accounts is north of 20%, around 21%, though that moves over time, so you should always check the current rate. Think about that. You are paying over 20% interest on money you spent on things that are not making you a single dollar. And then there is the car. You financed a vehicle that loses value every single day. While your stocks were crashing, your car was quietly depreciating in the driveway. You are paying a high interest rate on something that is worth less today than it was yesterday. You feel trapped. You tried to use debt to get rich, but instead, you find yourself working just to pay the interest on your loans. You are not using debt as a tool. The debt is using you. And maybe you do not have to imagine this. Maybe you have felt some version of it already. That feeling of running on a treadmill, moving as fast as you can, but never actually getting anywhere because the interest keeps pulling you back. This is the emotional bottom. And this is the moment you finally realize that the viral headline you followed was a half-truth. Yes, it was true that the rich use debt. But you had been copying the action without ever understanding the conditions. So you do something different. Instead of looking for the next hot tip, you start to study. You look at what the wealthy are actually doing, the boring, careful version that the hype videos never mention. And you discover that the rich do not just borrow money to buy things or gamble on stocks. They borrow against assets that produce income or grow in value. Take real estate. A wealthy investor might take out a mortgage to buy a rental property. In that case, the rent paid by the tenants helps cover the loan. The asset itself is helping to repay the debt. And there is a legal boring edge here too. Mortgage interest can be tax deductible. Interest on home loans used to buy, build, or substantially improve a home is deductible on up to $750,000 of the loan balance. Or $375,000 if you are married filing separately. This is not a secret loophole or a magic trick. It is just a standard part of the tax code that makes borrowing for a home more efficient than borrowing for a car. Then look at business loans. A business owner might borrow money to buy a new piece of equipment that lets them produce far more than before. If the loan costs them a low, fixed rate, but the new equipment earns them far more than that loan costs, the debt is actually creating wealth. The loan is paying for itself and then some. And even with margin trading, look at how the professionals do it. The wealthy do not put their last dime into a margin account. They keep huge cushions. They might only use a tiny fraction of their available margin so that even if the market drops 30 or 40%, they are nowhere near a margin call. They also understand that investment interest expense, like margin interest, is only tax deductible up to the amount of their net investment income. They know the tax rules and the risks long before they ever place a trade. And that is when it hits you. The difference between good debt and bad debt is not the amount of money borrowed. It is what is on the other end of the rope. If the debt is attached to something that loses value or gets consumed, like a fancy car or a dinner out, it is a trap. If the debt is attached to an asset that grows or produces income and the rate is low and fixed, it can actually be a tool. And here is the part you really need to hear. For most people, the problem is not that they are not using enough debt. The problem is that they have an expensive consumer debt problem. Once you see that, you realize that paying off a credit card with a 20+% interest rate is actually the best investment you could possibly make. Why? Because paying off that card is a guaranteed return of 20+%. There is no stock, no real estate deal, and no business venture that can guarantee you a 21% return with zero risk. That kind of return simply does not exist anywhere else. So this becomes your turning point. You decide to stop guessing, and you start using a filter. 4 simple questions that you ask before you ever borrow a single dollar again. And it is not a dry checklist. It is a whole new way of thinking about money. The first question is this: what is on the other end? You look at the loan and ask whether it is attached to something that grows or produces income, or something that loses value and gets used up. If it is a car, a vacation, or a gadget, it fails the test right there. The second question: what pays it back? You ask whether the asset itself or the income that asset produces helps repay the loan. Or is the only thing paying it back your monthly paycheck? If it relies solely on your labor and your time, that is a risk. If the asset helps pay for itself, that is a tool. The third question: what is the rate and is it fixed? Double-digit interest rates are a massive red flag. And you learn to fear variable rates too, the kind that can spike the moment the economy changes. You want low, fixed rates that you can actually predict and plan around. And the fourth question, which might be the most important of all: if the value dropped 30% or if your income paused for a while, would you still be okay? This is the cushion question. You ask yourself whether you have enough of a safety net to survive a worst-case scenario without being forced to sell at a loss. And the rule that comes out of it is simple. If the asset grows or pays you, and the asset helps repay the loan, and the rate is low and fixed, and you have a cushion, then it is a tool. Otherwise, it is a trap, no matter who is doing it. Even if a billionaire does it, borrowing at 20% to buy something that depreciates is still a bad move. So with this new filter, you begin your payoff phase. You stop hunting for a new investment. Instead, you treat your high-interest debt like the financial emergency it actually is. You list every single debt you have, with the exact interest rate written next to it. You look at that 21% credit card balance and you finally see it for what it is, the biggest leak in your boat. So you attack that card first, with everything you have, knowing that every dollar you pay off is like earning a guaranteed 21% return. You stop financing things you cannot afford. You sell the fancy car and get something reliable and modest, removing that heavy monthly payment and the stress of watching it depreciate. And you refuse to touch a margin account or borrow money to invest until you are completely free of expensive consumer debt and have a real cash cushion in the bank. And somewhere in here, you reframe the entire goal. You stop trying to use debt like the rich, and you start focusing on stopping debt from using you. Because you finally understand the real secret of the wealthy. It is not that they love debt. It is that they are terrified of the wrong kind of debt. They obsess over rates. They obsess over cushions. They do not borrow to buy things. They borrow to buy income. And then, much later, after you have built a solid foundation, you might use debt again. But this time, it looks completely different. Maybe you buy a modest property with a low fixed-rate mortgage where the rent covers the payment and leaves you with a little profit. You run the 4 questions. You make sure you have a cushion. You know exactly what is on the other end of the rope. And the debt is no longer a source of anxiety. It is a tool that is finally working for you instead of against you. So let me bring this back to right now, tonight. If any part of that story felt familiar, I want you to take it as a gift, a warning you got to hear before it cost you everything. If you are carrying a balance on a credit card today, understand that you are sitting on a guaranteed return. If your rate is north of 20%, paying that off is the single most productive thing you can do with your money right now. It beats the stock market, it beats real estate, and it beats any hack you will ever see on a screen. So here is your move. Take a piece of paper and write down every debt you owe and put the interest rate right next to it. Look at those double-digit numbers and recognize them for exactly what they are: financial emergencies. Stop looking for ways to use leverage to get ahead and start focusing on removing the leverage that is holding you back. Build your cushion first. Get your rates down. And once you are no longer being used by your debt, then, and only then, you can start thinking about how to use it as a tool. Because remember, the people who actually get rich with debt are the ones who are the most cautious about it. They do not gamble with their survival. They use the boring, careful version of borrowing. They make sure the asset pays for the loan, not their sleep and not their sanity. They understand that leverage is a powerful engine, but if you point it in the wrong direction, it will just drive you toward the cliff faster. Thank you so much for spending your time with me today. If this helped you see your own debt a little more clearly, please subscribe to the channel and hit the bell so you do not miss any of our future videos. And I would love to hear from you in the comments. Which debt are you working on paying off right now? Let us support each other in getting those balances to zero. Do your own research, be honest with yourself about which kind of debt you are holding, and I will see you in the next one.